Hello friends, a very good day to all of you and hope you are all doing fine. Over the next few minutes, we would discuss some of the key events of the recent past related to the Indian equity market and also present our views on the market outlook. The Indian equity market movement during the past month remained quite volatile. The Nifty 50 index went down by about 6%, with the broader market even weaker, with small cap segment registering a cut of 13% during the previous month. Market breadth, as measured by advanced decline, went further down on a month-on-month basis during the month of February. MSCI India was down 8%, underperforming the MSCI Emerging Market Index, which was up 0.4% during the month. FIIs continued to be sellers in the Indian equities during the month to the tune of $6 billion, while DIIs, supported by strong SIP inflows, remained net buyers to the tune of $7.5 billion for the month. India's GDP grew by 6.2% in third quarter of FY25, recovering from a 7-quarter low. For the full year FY25, government now forecasts a GDP growth rate of 6.5%, slightly above its initial estimate of 6.4%. Corporates' earnings were in line with the expectation for the third quarter. There was some pressure on revenue growth for most consumer and capital good companies, though the numbers posted by IT companies were good. The outlook for IT companies improved during the quarter. Banking sector also posted good profit growth and displayed an improvement in the asset quality. On the valuations front, large caps are now trading at par with the historical average, while mid cap and small caps are still trading at multiples higher than the long-term average. Delivery of earnings becomes even more critical, especially for mid caps and small caps. We would look at buying high-quality companies available at reasonable valuations. As far as our portfolios are concerned, we continue to focus on economic recovery plays, consistent compounders that have room for higher than average market earnings growth, as well as possible valuation re-rating. Domestic cycles, including auto, capital goods, and manufacturing, continues to be attractive over medium to long term. The recent pickup in government capex can also help improve the fundamentals of these sectors in the near term. We also expect discretionary consumption to pick up post the tax stops given by the government in the recent budget. Information technology also continues to be promising, with discretionary spends in US likely to improve. On investing in equities now, we believe that one needs to follow time-tested principles of regular investing and long-term focus. With expectations of continued volatility in the short term, we advise equity investors to make disciplined and regular investment with long-term focus and utilize periods of volatility to build on long-term portfolio at better valuations. We continue to be positive on the corporate earnings cycle over the next few years. We advise investors to have a slight tilt towards large caps and look at mid-cap and small-cap strategies only from an overall cycle perspective and have an investment horizon of at least 3 to 5 years. The key risks to watch out are both global and domestic. On the global front, we would watch out for policy changes in the US, both fiscal and monetary, including tariff-related measures which could impact global growth dynamics. On the domestic front, apart from the policy-related measures, the key factor to watch out for would be the delivery of corporate earnings in the coming quarter. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.